Good evening, everybody. I am back to do more closed-end fund updates. Took a week off, did a lot of research on just market and strategy overall, and back to talk closed-end funds. So, my name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk more just about investments, current strategy, and closed-end funds. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. Uh, Cat is roaming and needy. He's really hoping somebody plays with him. So I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I mean, really of what you can tell already. But I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So quite honestly, it's a pretty cut and dry video. It's really a pretty cut and dry strategy right now. The bond market is dogged. I mean, so where would I invest? I would invest in bonds. But since since Brett Owens already said this extremely well, I'll share a snip of stuff he's already said. That way you can pause it and look at it. It is not his whole email. Uh, I mean, the next CPI meeting is this week. Trump gets inaugurated tomorrow. Half the country is going to be kind of snowed in or iced in, so it kind of looks like uh, a slow week in that regard. But I mean, Trump sounds like he's going to be uh, coming out swinging. He's got a lot to do in the first couple of days, and his team is ready. But on the investment end, I mean, yes, there's a lot of ways we can trade online now. But I don't know what the market will do this week with CPI data on Wednesday and the snowstorm. So maybe it'll be a slow week. On our end, that would kind of help our advantage in a way as we start to look at moving money around. So the biggest takeaway off this image, which maybe I didn't share that image, maybe I'm still on my views. So let me go back and now share my view. Maybe that would make more sense. So you can read this. Maybe that'll get in the way, maybe not. You can read this at your own pace, but the biggest takeaway is that highlighted part at the bottom. Bonds are despised right now, and so are bond proxies like real estate and utilities. So, what does that mean for us? Well, it goes back to your own portfolio and what you already have. I'm not, let's see, it goes back to your portfolio and what you already have. It goes back to the funds you have at your disposal, or maybe the funds you have at your fingertips that you can invest. Um, but it also goes back to just overall strategy. I'm not the kind of guy that just likes to smear money here and smear money there just for the sake of having money here and there. So you really do want targeted strategy. And like if you're invested in bonds and you have nothing in the other two, it's not like you're going to snag 100 here, 100 there. Invest in what my advice would be invest in what you already have, unless you're hoping to find and add something else over time. Like if you're going to really look at targeting utilities, which is hard right now, or targeting real estate, which is hard. It's easy in the sense that bonds are dogged right now, but I don't know how long it's going to stay that way. So whether it's straight out bonds, whether that's municipal bonds, or even if, say, between utilities and real estate, or even energy, if you're going to get into that, it's hard. It's hard to get into that long term, not knowing for sure how the market's going to go. Like we can predict how we think the market's going to look in a year, 2 years, 4 years, 8 years. But all the time in between is so uncertain. So timing the market, I think, is just crazy hard, or like almost like you get either so confident you try to time the market, or so not confident in that you wait to invest, hoping to time the market. It's much easier to play the current market with a long term in mind. So It's buy the best thing you can right now in regards to your own portfolio. Don't just spread money. Don't spread money around too much, like the whole butter scraped over too much bread analogy. Don't diversify just for the sake of diversification. Find the best thing you can buy right now in general, and then see how that impacts your own portfolio. So where would we invest right now? Well, from Brett Owens and then really from Jay and from the market itself, it's really hard to train yourself to buy stuff that everybody else hates. Like it's really hard because it's almost like its own mini psyop. Like everybody's going somewhere else. It takes a lot of wherewithal and a lot of ability and a lot of intestinal fortitude and a lot of bravery to look somewhere else. And for us, that's bonds. And you can look at bond proxies, energy, real estate, utilities. I think you also look at not so much individual real estate, not like Remax, not that, like maybe real estate investment trust, uh, but it's still using the closed-end fund system of the best discount, uh, the best current discount in relation to its past discounts, and really trying to hyper focus on the, we'll say, it's going to sound redundant, but it's hyper focusing on the strategy as applied to this current market, looking at the long game of things and not hoping in the other stuff. It's almost like it's not looking at the facts, but you're trying to read the tea leaves. You're using the best information you have right now, with the system in place right now, with the strategy in place right now, with your portfolio right now, and then somewhat based on where you think the market's going to go overall. So let me share this screen. Yeah, the Zoom screen. Let me share this screen. So of the closed-end fund target list for the week, some of it's changed, but mostly it hasn't, which we're still looking at about 25 funds, which I've already moved over here, at least the top bit over here. If we rank them by discount, there are a couple that have changed. And that is interesting that it won't scale because of that. We'll take that away, put that back. Yeah, we'll leave it. Um, let's see. We'll make it that. So by discount, so crazy discount, meaning for every dollar invested, you're really paying 44 cents, which is an insane deal. They've closed the gap a little bit. They're trying to close the gap a little bit. I mean, their price has risen a little bit. I still see hope in this company. And I've been saying that for a while, but I mean, I've seen enough hope to where we've bought this company, and we've increased our shares in this company. So, um, on the polar opposite end, I generally don't leave stuff in positive on the list. I mean, the whole purpose is to buy discount and not buy premium. And in saying that, there's two premium funds that I've found that really are exceptions to the rule simply because they're always in premium. And when they're, it sounds so crazy to say this to me, but when they're in premium as they are, they're actually at a decent price. It so I mean you can read this just as well as I can read it to you. Um, but for premium funds where people are really willing to pay double digit premium, I'll scan this one out or span this one out so you can read it too. Um, but as these funds swing into, 10% plus, which is like paying $1.10 instead of a dollar, break even would be a dollar, 10% up, like 10% premium would be like $1.10 for every share invested. So if it's really going to swing into $1.15 for every dollar invested, and then drop back down to sub 5%, I get that we're If we bought it, we would be paying a premium, and the whole purpose is to not pay premium. But at the same time, for the premium funds that people are willing to buy, I think I have to make an exception to the rule. I don't know if it ends up in the final cut list, uh, but it at least makes this list in the same. So this is a bonds fund, and then DNP is a utilities fund. So depending on how close it is to the general average of things, like this one, I think you could make a case for because the 52-week average is around 4, and that's at 4. This one, 52-week average is +8. So yeah, it's so on average over the last year, people are willing to pay $1.08 for every dollar invested. So 8 cents more, right? And currently it's at 4. So even though it's not a discount in the sense that it's negative, like any of these, it's a discount in relation to the fund because it never goes into discount territory. So that being said, we don't own any of these funds right now. We own this stuff in dark blue. And honestly, of all the stuff in light blue that we own inside the individual portfolio, none of that is currently on the discount list. This cleaned up really well, like based on last year's data, where I just waited until the end of the year to clean everything up. We had all these sold funds and it was just really messy. This cleaned up really well. It's three funds that are well, that it's long term, but they've kind of got general parameters in the sense of, yeah, sell that one about 9. NML is tracking higher than it's been in a while, really ever. But it's playing the system on the oil and gas and energy infrastructure until that starts to curtail. So maybe it'll scale, but the goal is that it continues to grow in value and then pay a nice dividend. And if we see a waning of the market where it's going to drop back down, because everything is cyclical, then when that happens, yeah, we'll probably sell them. Bonds, I love the DSL bond fund. It's just not the right time to add it back because it is currently premium, but it also sells for a discount. And I think when we can scoop a really fat discount, that's the time to buy DSL. And these other two, gosh, I'm hoping a different economy will help these other two back up, and then we'll sell them at that time. So for this video, there we go, of what would make the final cut. I think it goes back to the overall strategy focus. So bonds are despised, so are bond proxies like utilities, real estate, and I had another, and energy transfer. So that really eliminates a lot of the list by itself. This is a utility, but it's a solar utility and it's a term fund, not my type. I can own that fund inside BRW. ERH is utility. Haven't actually heard a lot great about it. CHW stocks. ADX is a quarterly payer of mostly US stocks. Um, and it's a pretty interesting fund, but it's not going to make this list. Saba, uh, same company that owns BRW, but Saba primarily government bond. NPCT is interesting, uh, but it goes to I can't, especially in small batch. Like if we're going to pick up 50 to 100 shares of something, buying 50 to 100 shares of something we don't already own has to be better than what we already have. So for buying small batch, I can get rid of a lot of the list. Municipal bonds, if you're going to really add a significant portion, municipal bonds are interesting. We don't have any municipals, but it's essentially tax-free money. GMO, ETP is stocks. Hicks is bonds, but it doesn't outpace the market, doesn't outpace the benchmark, which like it pays a fat, where are we? Hicks pays a fat dividend, but it doesn't do better than its competition. So you're getting a great dividend without a lot of growth. PDT does beat its market, but we don't already own it. CGO is stocks. which you could make a case for stocks. US stock market this year is supposed to explode, supposed to, right? But you can also kind of predict that based on Trump and tariffs and homegrown goods. Um, I mean, you can look at this review I found on River, but it's this last part too. It at 22. I mean, yeah, gosh, if it scaled back to 22, that'd be amazing. Um, but it's not better than what we currently have. And then you've got utility, bonds, and utility, and it's all tempting. I mean, it really is. It's all tempting. We can get into the goods on all of it, but it's not really better than what we have in small batch. So if we're going to focus on what we have, or at least if I'm going to focus on what we have, and I am, and we are still investing in small batch, like maybe 50 to 100 shares, what's the best thing on the list in the current market and also for the whether you want to say short term, say like the next 3 to 4 years or even beyond, what's the best thing? You've got real estate. I do. I mean, if bonds are despised, HFRO is just dogged. I mean, just dogged. It's been at 50 to 60% off for like a year. Um, yeah. And I've gotten into why that is in past videos, but at this gosh, after a year of that, with them paying the dividend and with them growing the overall NAV, I don't get the disconnect. But at the same time, it would be a really good option, but I don't think it's the best option. All of these are great options. The only one I would hesitate on, simply because of the overall fears of some type of pullback in the tech market. Like tech has been amazing the last year. You've got a couple different people going, maybe there'll be a little hiccup, maybe not, but that goes on timing the market. Maybe you time it, maybe don't. Um, that's gained in value since we picked it up. Um, and it's tempting. It is. It's tech and then not outright tech. Like it's direct investment into tech maker, but it's also investment into a lot of companies that really all these other companies that use tech a lot. Uh, but it's not the best thing I think on the list. BRW is a close second because it's got the bond side and it's got the stock side, and they invest into a lot of other stuff besides. I mean, like they used to they invest in precious metals and minerals, and they invest into TEEF. So instead of buying TEEF outright, I can buy it through BRW essentially. CIF is just a really small corporate bond company that has, say, it dropped into like 1.72 at some point, which I get is not a huge thing, but it's slowly creeping back up in value. Uh, my hope is that it scales back to close to where it used to be, and then we'll sell it and then roll the money forward. But honestly, for us, I think the best bet is to buy this company. So it's a bond company. Bonds are despised, right? Bond proxies are despised, but bonds are just like downtrodden right now. But you've got a company it is a bond company. It's a ton of corporate bonds, but it's an all-American company, and it's a company preparing for the coming market. They're already prepared for the coming market, but the coming market where the Treasury Secretary is an entrepreneurial guy who wants to lend to small business. FSCO is a BDC or a small business lender. So they're a bond company of all American funds, and they're already set like they're a private lender as is, but they're already set up to lend and bridge the gap for all these small businesses that have just been struggling the past 4 years. And in the missive I read on Friday uh, through routers, which I weirdest thing, post on my Webull account, it says something like article is the opinion and not the maybe not the opinion or of Webull, all that stuff, like the general disclaimer. But there's no article there. I actually have to dig through it on the online. But the press release, they're going to release like 100 million worth of common shares in the hopes to generate more investment into the fund so they have more cash on hand that they can then spend, right? To spend the fund. And in the coming economy, the coming market, which really isn't that far off right now, like things change tomorrow, they'll take a little while to establish in in the country overall, but the existing status quo changes tomorrow. And it's already been changing through what Trump has done, but it changes for sure, for certain, officially tomorrow. And they're setting themselves up to have money on hand where they can lend out and then make more money for the company as a whole. I like that idea. So all of these funds are great pickups, but for us in our portfolio, FSCO makes them the best sense. Now, if you're building a portfolio, that's a completely different game. Um, we 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 liquidated our Morgan Stanley fund, and we are looking at where we're going to invest. And as I said this last week, between my uncle and a friend who's like my brother, it was, you really haven't seen a ton of growth. Why stay where you are, even if you're calling the shots? That was my uncle. And my brother went, if you're really going to do all the work and you're just going to tell that guy what to buy, why leave it there when you have to pay him a percentage of proceeds or like a monthly, like a monthly payment? Now, I don't mind paying people for the job they're doing. If our stock account or our brokerage account did extremely well, that guy should have a cut of the share of the profits, right? Like he's done a ton of work. But my brother makes a great point. If I'm doing all the work and that guy's just ordering the stuff, why don't we cut out the middleman and not pay the fees? And you put the two together, and it kind of goes with the same with our sentiment over the years. We haven't talked to that guy a lot. He's a nice guy. We haven't talked to that guy a lot. We haven't met with him in the last 3 years. And I mean, outside of them having maybe a high yield fund where we can tuck an emergency fund away, I don't know if we'll be staying with him, because if I'm going to do all the work, then if I'm going to do all the work and he's just going to, invest it where I want, it just seems like wasted money we could spend somewhere else. But we'll see. Um, we'll see. So if you're building a stock portfolio and you're starting fresh, that comes down to assets overall, like how much you're going to invest. It comes into your overall strategy, comes into a lot of different stuff that we've talked about. I think this is like almost the 180th video. And that's a lot of videos. That's a lot more than I thought I would make. I mean, I knew I would make videos, and I knew I would make a lot of videos. And the whole point of the videos is to explain the strategy, but also to help somebody else, and or maybe help somebody else by explaining the strategy, however you want to put those together. And I just didn't realize it would be that many videos. Um, just kind of crazy to me. So yeah, crazy enough that I lost my train of thought. Uh, yeah, who knows? But if you're building a portfolio, that's a very different thing than just adding stuff every week. And as so if you're building a portfolio of pick your starter amount, like if you're putting in 10 grand, that's 10 grand. But if you're putting in 50 grand, depending on how you want to structure it, how you want to invest it, as tempting as it is to do like a one-time scoop, like just a dollop into the market, I would tell you to evaluate your strategy and then figure out if you want to spread the investment over a month or two, right? Or maybe three. Like you could go 10, 10. So 50 grand, you could go equal amounts every 4 months, right? You could go 25 and 25, however you want, 50 all at once in an uncertain time of the market where the market really could do any number of things. Um, yeah. And on the flip side, that's me. It's we have the set amount, and as tempting as it is to just be like this, Like I know what I want. I know what I want to buy. I have all the data. It's this. There is some wisdom in spreading out the investment over a couple months. I mean, if anything, you can find another downtrodden, just dogged section of the market and scoop an amazing bargain. Or maybe the stuff you thought would do really well a month later just drops 50 cents or a dollar. You just pick it up for cheap. So it really all comes down to your strategy. And it as much as you want to be like, yes, I'm doing this, be confident, but be confident, but also don't be so confident that you miss some stuff. At least consider some other options. So, but that's for us in this video, that's all I got. I'll update. I mean, you can see the tab. It says portfolio overhaul. I'll update that whenever we have it. But at least for this video, if we're investing tomorrow, and we're not, but if we're investing tomorrow in small batch, 50 to 100 shares, FCO is by far the best bet for us. Bonds are dogged. It's a bond fund. Incoming Treasury Secretary is an entrepreneurial guy. There we go. And we need small business involvement in this country. And for this company to be a private lender and to bridge that gap between what you can find at your bank and a big company, right, where they can really give small businesses a ton of money, that's what we need. And they're well prepped for that. Plus, it's an all-American company. And that is the push right now. I mean, I love all-American companies. I mean, yeah, that's its completely own rabbit hole, which as much as I would love to get into that rabbit hole, not on this video. So all American bond company, private lender, BDC, business development company, really does set this one apart compared to the rest. So that would be my bet. So let's see. If you have comments, by all means, drop me a comment. If you want, I mean, I really am curious what y'all are buying, but if you want to drop a comment on closed-end funds or talk about what's in your portfolio or anything else, just drop a comment and let's chat. You can also find me on Instagram at the same Adaptive Perspective handle, and and I'll post this video on Instagram as well. So whatever you have, I wish you a great week, but I also wish you a safe week. I mean, for us where we are in Texas, it's going to be a cold week and maybe a snowy couple days. So wherever you are, I hope you're warm, hope you're safe. If you got to go into work, I mean, I get it. When we lived in Lubbock, we had to drive into work in blinding snow. So I mean, I get it. Um, be safe, take care of your family, stay low. Maybe it'll be a slow economic week, and then we'll pick it up and see what next week looks like. So I wish you well. And if anything, if you have nothing to do tomorrow, then I would say watch the inauguration because I will be watching that video. So wish you well. Talk to you later. Bye bye.